My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends, just trying to make you some money. My job is not just to entertain you, but to educate, teach you, and find out how these days could happen. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. How do we explain today's tremendous rebound with the Dow jumping 599 points? Bye. The S&P 500 surging 2.14%. And the NASDAQ skyrocketing 2.92%.
House of pleasure.
It sure doesn't hurt that the price of oil plunged more than 7% today, dropping back to the 90s. Remember, oil's a tax on all of us. But I think a lot of this comes down to Ukraine. See, the war's taking too long for Mother Russia. That's what Vladimir Putin is discovering. He wanted a short, victorious war. He's gotten a morale-churning, expensive slog. He just can't conquer Ukraine on a decent timetable. There are simply too many buildings, too few roads, and too much modern weaponry on the wrong side of him. Right now, at this very moment, there's a real chance that Putin's got a quagmire on his hands, maybe even a defeat. And this from a man who thought he was invincible. One major reason he stalled is the entirely unexpected leadership of President Zelensky, a comedian turned head of state who stepped up in his country's time of need. Incredible contrast to most world leaders who would have been on the first chopper out of Kyiv the moment the bullets started flying. Plus, Russia spent 8 years arming separatist rebels in eastern Ukraine. Major misstep because it gave the Ukrainian army a ton of practice. The Ukrainians know what they're doing. Many were trained in the Russian army. The more munitions they get from the West, the less likely Russia wins. The more provisions they get from the West, the less likely Putin's classic Stalinist tactics, forcing famine, will happen. They won't be able to starve them to death. Unbelievable a month ago because Zelensky, Putin may not have the horses. Of course, Ukraine isn't necessarily the main driver of today's rally, but the fact that the cracks are appearing in actual battles is pretty huge. Remember, it took well-trained U.S. Marines 3 weeks to clear a large town like Fallujah with 36,000 buildings. Thank you, Bing West, for this. Kyiv has 300,000 buildings, nearly 3 million people. Good luck, Mr. Putin. If the Marines had a tough time, what will your troops experience in a treacherous urban battlefield 10 times the size? Because the Ukrainians have rallied around Zelensky, because he didn't flee or make some awful deal, Putin may actually run out of money. Russia made a default, ugly, embarrassing default. And it wouldn't be the first time that an army had to retreat because it's broke. Check out World War I. Check out what happened in Germany. Now, you could say that a lot of this was known before today's big rally, but here's what I see happening. See, the West is beginning to figure out that there's a third way between Russia winning and Russia losing. That's Russia running out of money to wage the war simply because it's already gone on too long without a lot of progress. And the sanctions are having an impact. And most important, it's difficult for Putin to shell Kyiv. This is really the major story. When there's a possibility he might kill visiting world leaders who would never have gone had Zelensky not shown the courage. It's certainly not a war that China wants back, at least not to the hilt. I have a ton of problems with the Chinese government. The Communist Party's done some terrible things, but they're not stupid. They know they need the markets of Europe more than they need Russian natural gas, which they can get even if they don't lift a finger because Russia's in dire straits anyway. 25% of their exports go to the 775 million strong EU community. You think they just want to just say, we don't need that market? They need it more than ever. Last night I talked about how if we got anything good, the pessimism could be a springboard for the stock market. After the close of trading, I got my trusty number from the S&P oscillator that I so coveted, the one that tells me when there's too much selling pressure, and it came in at minus 5.23. Anything under minus 5 means we're oversold and ready to rally. Plus, we got a Bank of America survey of fund managers that Bob Pisani talked about this morning, which showed that global growth pessimism hasn't been this negative since the summer of 2008, just before the collapse of Lehman Brothers. Put those together, and we had all the ingredients of a coiled spring. Sure, the war dragging on may not count as something that Wall Street will continue to view positively, but how about a startling break in inflation ahead of tomorrow's pivotal Fed meeting? I'm talking about the nosedive in the price of oil, with West Texas Intermediate crude back to $95 a barrel. Now, I am a huge believer in oil. You know that. I believe the oil stocks with big dividends should be bought on any weakness. That's what we're doing today for the Charitable Trust, as chronicled for the CNBC Investing Club that I hope you'll join. What matters here, though, is that while all sorts of commodities are soaring, oil's the only one that really stands out, and it's breaking down, giving us hope that Fed Chief Jay Powell can gently cool down the economy with a softer landing rather than strangling the heck out of it. Plus, lower oil is always good for the vast swaths of the economy that are taxed by it. Oil down 7 instantly makes the airlines more profitable, especially now that it looks like summer travel plans are heating up. The airline stock's naturally short on the news. That explains the general tone, because that happened very early. But how do we explain the tremendous rally in tech? Now, this former leadership group has crushed people since November, so relentless dip buyers have turned into endless sellers at a loss, destroying the morale of the bulls with their pain. I examined all the research this morning. I found absolutely nothing that's all that positive about tech in general or semiconductors in particular. But I have some real insight into what may have changed the mood. Our interview here with Matt Murphy, CEO of Marvell Technology. Now, not a lot of home gamers know Matt or his company. They know Intel. But the professional investors know Matt and love him. Marvell's a chip maker that plays in every important end market there is, from the data center to 5G to the autos to high-performance computing, gaming, everyone. When we spoke to him last night, he didn't just suggest that these areas are strong. He flat out said that Marvell has more business than it can handle in every single one of its verticals. I'd heard endless rumors that the opposite was true, but Matt's straight shooter, and if any of those end markets were weak, why not admit it? The fact that they've accelerated, not just stayed the same, but accelerated in the last month was simply not in the bearish calculus. Matt's Mad Money appearance busted the semiconductor shorts, as we explain in our morning investing club missives and videos. So let's put it all together. At the same time that key portfolio managers are pessimistic, we have an optimistic moment in Ukraine, where while the consumer is still spending, as demonstrated by positive airline numbers, and the enterprise is still spending, as demonstrated by Marvell's comments on our show last night. Immediately, I heard that the whole rally was just short covering, could be dismissed. We could go right back down tomorrow if the Fed says the wrong thing. There's some truth to that. This market's about as fragile as any I've seen in years. There are so many chartists and fundamentalists who've lost hope given high inflation, slow growth, less accommodative Federal Reserve. You know the particulars. As soon as stocks are overbought, if we even get there, I think that we could easily have a rinse and repeat situation. What matters to me, though, we're constantly being reminded that this market goes down, not in a stair-step fashion, but in a couple of days' decline, followed by a spike, either from short covering ahead of an important issue like the Fed unemployment data, and then a resumption of decline. I think this spike is still a good chance to reposition weaker portfolios. But the bottom line, sessions like this one are also a reminder that when things look really horrible and we've been down for days and days and days, you don't need to despair. You just need to be more clever. Raise some cash on the up move and steer yourself for the next decline if either oil prices or the Russian army advance to places where we really don't want them to go. Derek in Georgia. Derek.
Hey, Jim, I need your help, buddy.
I'm there for you. What do you want?
All right. I bought some Macy's after it hit its high right around Thanksgiving. It started to pull back. I knew they had good inventory. Sales were going to be great. They post great numbers, top line, bottom line. They have great forecasts, and they even increased their dividends, and that boy has been going straight down. What do I do, Jim?
You stay long and you buy more, okay? 2.5% yield, much better balance sheet, and a 5 PE? I have to apologize to Jeff Kennett, the CEO, for what the market is saying about his work, because the market's wrong. And you, my friend Derek in Georgia, are right. How about we go to Mike in Florida, please? Mike.
Hi, Jim. Question about Boston Beer, symbol SAM.
Yes.
Great balance sheet, no debt. However, stock has been pummeled. Looks like a miscalculation regarding the hard seltzer. Is the pain over, or is there more to go?
No, it's not over. They still, I'd rather buy Coca-Cola here. I'd rather buy, let me give you one that's just much better, Molson Coors. I know people don't think of TAP as a good company. Those people are wrong. It's really making a major comeback. Good, much better balance sheet, really good restructuring. Go into TAP, will you? That's the way to go. Hey, how about Ara in Ohio? Ara.
Hey, Jimmy, this is Ara. With grilling season right around the corner, I'm calling about Weber. I'm shocked to see 40% of the float is short. While inflation's hit the bottom line, they have a good amount of debt. Yet they're highly profitable and they're a great brand. What do you make of this large short position?
Well, I got to tell you, I talk about when I'm right. I had thought that Weber would have rallied. The short position is humongous. The PE is low. I like your call. At $10, I mean, you really got to just say, they're either going to, either nobody's going to grill ever again, or you buy Weber. All right, sessions like today are a reminder that when we've been down for days, don't despair. Just get a little clever. Raise some cash. Get yourself ready for the next decline with more defensive stocks. There's plenty of them out there. Mad Money tonight. CrowdStrike reported last week it shot the lights out. So can this cybersecurity play continue to defend itself from the tech bears? I'm checking in with the CEO. And trying to spot a bottom in the S&P amid recent volatility. You know what I'm going to do? I'm going to turn to the queen of Fibonacci herself and go off the charts because she's been making people money. Hey, and by the way, the best retailer in the world, Costco, caught in the corsets of inflation? Well, I'm learning about how much they know more than anybody else. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.